One of the most famous debates that you're going to hear as a real estate investor is, should you pay cash for a property or should you finance the property? And I'll tell you, you're going to meet people on both ends of the spectrum, and they're going to defend those ends of the spectrum very hard. But hopefully I'm going to give you some information that can help you decide this for yourself. I'm going to caveat all of this because you're going to find out pretty quickly that I'm a big fan of leveraging. But if at any point leveraging stresses you out to the point of losing sleep at night, don't do it. I don't care how high the returns are. There are no returns worth you losing sleep at all. So that's my caveat. Don't finance if it's just going to make you uncomfortable, because that is the case for a lot of people. And the other kind of disclaimer / caveat is, everything I'm about to tell you is absolutely dependent on you financing or leveraging intelligently. There are a lot of ways to get in trouble with financing. You have to be smart about what you're doing, and you need to understand what you're doing, because if you don't, everything I'm about to tell you is not going to be applicable and you might get yourself in trouble. But assuming you are smart in setting up your financing, I'm going to use some very ballpark numbers to actually give you kind of a picture of what financing can potentially do for you. So I use the words interchangeably, leveraging and financing. You can check out my video called "What Does Leverage Mean in Real Estate Investing?" And in my opinion, there's different ways to leverage, not just financially. But we're going to hit the financial numbers from financial leverage. So you're using a loan, you're getting a mortgage, you're using other people's money. So I'm going to look at an example of a $100,000 rental property. I'm going to keep all of these numbers very basic. They are absolutely leaving out some reality as far as like closing costs on the loan, like little intricacies. I'm using the most generic numbers possible to just paint you an easy picture. So with that, I'm going to share my screen. So I've kind of mapped some of these things out here. All right, let's see here. Okay, so first scenario, you are paying all cash for this $100,000 rental property. This rental property is getting $1,000 a month in rent from the tenants. And after your expenses, so like property tax, insurance, all that, you are pocketing $700 a month in positive cash flow. So you pay your expenses. After that, you're left with $700. Using the cash on cash return equation, I'm not going to go into details about this equation. If you want more information on how to calculate this, you can see my video called "How to Calculate Numbers on a Rental Property." But you can see the equation down there. I at least included it. But ultimately, what your cash on cash return is telling you is, what is the actual return you're getting on the money that you invested? For me personally, it's my favorite return equation when I'm looking at properties, because ultimately it's what I care about. How much am I getting as a return on the money that I put in? So in this scenario, you are getting an 8.4% cash on cash return on this $100,000 rental property that you have paid all cash for. Let's look at the second scenario. The same $100,000 rental property, same $1,000 a month in rent, but because you're financing, you now have to take your mortgage payment out of the equation. You can see down there, I'm assuming a 5% interest rate with 20% down, again, keeping it super generic. This is the first point of contention that people are like, well, if I pay all cash, I can get $700 a month in my pocket versus $270. That's kind of a big difference. Yes, I completely agree. But what is the cash on cash return? Because we already talked about, this is the amount of money that you're getting as a return on the money that you invest. Well, look at the cash on cash return equation down here. The cash invested in the denominator is critical, because the cash invested when you paid all cash was $100,000. So you're making $700 a month on the $100,000 investment. Well, here, you're only putting in a $20,000 investment because it's your 20% down. Again, excluding closing costs and all that. So you're only putting $20,000 into the pot, and you're making $270 a month on that. So what does that actually equate to as far as a cash on cash return? It's 16.2. It's just kind of ironic that doubles. It doesn't always double. But instead of that 8.4% return, now you're making 16.2. You have almost doubled the return on your money. So let's start comparing these things. So yes, you're getting $700 a month in cash flow if you pay all cash, but that equates to an 8.4% cash on cash return. Whereas if you finance, you're getting only $270 a month, but because you only put $20,000 into it, it actually equates to a 16.2% return. Okay, so it doesn't stop there. So look at the cash on cash return. We got that in our heads. Now let's think about if you have $100,000 to pay cash on a property, because some people have to finance because they just don't have the $100,000. That's a very different scenario. But let's pretend that you have $100,000 to invest. So you have the option to buy one property for $100,000, or if you finance, now you can buy 5 properties. Because if it only takes $20,000 because of 20% down, again, leaving out closing costs, that's 5 sets of $20,000 equals your $100,000. So now we're talking about buying 1 property versus 5 properties. Well, let's go back to the cash flow equation. On the property you paid cash for, you're making $700 a month, which at the time seemed like a lot more than $270. But now for the same $100,000, you have just bought 5 properties at $270 a month. So that actually equates to $1,350 a month. So are you still making more per month cash flow if you pay all cash? Not if you use all the money towards properties. No, you're not. You have a potential of making more per month with the same $100,000. See, $1,350 is more than $700. Most people don't get that far in their equation. So let's think about, again, it actually still doesn't stop there. But wait, there's more. Just kidding. I'm not QVC. The benefits of 5 properties. So we already talked about you're going to get a higher cash flow if you use all of the money to invest in either 1 property or 5 properties. And ultimately, it's going to give you a higher return on your money because it is the amount that you're getting based on how much you put in. So in this case, it was almost double the cash on cash return. But what about appreciation? Everybody knows about appreciation with real estate, and quite frankly, it's why most of us do it. So let's look at this. Let's say that your $100,000 property appreciates to $150,000. So if you paid cash, you now have $50,000 free money in your pocket, because that's essentially what appreciation is. It's fantastic. It's free money in your pocket. You don't have to give it back to the bank you finance with. It's your money. But what if you had 5 properties and all of those properties appreciated at the same level? Now you have 5 times $50,000. So instead of $50,000 free money in your pocket, you now have $250,000 free money in your pocket, which is, hello, a very big difference. So we're not just talking about the cash flow. Now we're talking about appreciation. So now add this to our comparison list. We have what looks like higher cash flow per month on the all cash property, but we know that with 5 of those, that's not actually going to be accurate. But for all intents and purposes, there's our cash flows for 1 property each. You have an 8.4% return paying cash and $50,000 free money, or financing, you have a 16.2 return cash on cash, or $250,000 of free money. So you have 5 times the appreciation, which again, free money in your pocket. This is a whole different discussion, but rental properties actually have 5 different profit centers. You make money in 5 different ways on a rental property. We already talked about 2 of them, cash flow and appreciation. The other ones are tax benefit, equity build via mortgage pay down because your tenants are paying, and in the case of the finance properties at least, and your properties are hedging against inflation, which is a whole weird, complicated equation. We're not going to get into those, but just understand that if there are 5 different profit centers on a rental property and you own 5 properties, you're literally getting 5 times all of those profit centers, not just cash flow and appreciation. Here's another thing. If you own 1 property, and let's say you have a big expense on that property, whether it be a vacancy or just the roof falls off or something happens, that 1 property is all that's really kind of sustaining you, versus if you have 5, if those problems happen on 1 property, in theory, you have 4 other properties and their income to help carry you through that expense. You see what I mean? Like if you have one property and you have a gigantic expense, it's coming out of your bank account or whatever bank account, wherever you keep your money. But if you have 5 properties, the income from those other 4 that don't have the problem may just be enough to make this not even make a dent in your bank account. So that's huge, because this is vacancy and expense distribution. Instead of it coming out of your personal pocket to pay for this thing, I mean, it's still going to come out of your pocket. We're talking kind of more metaphorically here, but you know, if you have a $2,000 expense all of a sudden, and the other properties are all making whatever $1,350 or whatever, that's $1,350 less that has, let's see, I'm not doing that math right, but you get my point. Let's say that's $1,000 less than what would have to come out of your pocket to cover that expense. You see what I'm saying? So now let's go back to the comparison. We have our cash flow, we have our cash on cash returns, we have the appreciation 5 times. We have 5 times the profit centers on the finance properties versus just 1 time all the profit centers on the cash properties. And the cash properties, there's not as much of a way to distribute the expenses if that happens. On the finance property, you have that ability to distribute the expenses across the properties. So most people, I shouldn't say most people, a lot of people really argue for this paying cash thing. And their reasoning for it is they say leveraging is risky. I said in the beginning, if you do leveraging wrong, it can absolutely be risky. For example, adjustable rate mortgages, not safe, because there's just a whole, like when the rate changes and then it may mess up your cash flow and all sorts of things can happen. Interest only loans, short-term loans, there are a lot of loans that can get you in trouble. But if you finance intelligently and you know what you're doing and you know the risk, you get a fixed rate loan, you know everything going into it, think about risk in this way. The bank who you get the loan from actually holds 80% of the risk. You only hold 20%. So on this $100,000 property, you're 20,000 into it, they're 80,000. So if something on this property goes belly up, sure, you may have to foreclose and it might mess up your credit score. But from a financial perspective, the bank is holding 80% of that risk, not you. So you actually kind of need to look at this risk thing objectively. Yes, again, your credit score is absolutely a risk if you have to foreclose or short sale or whatever. But what are the numbers? Like, who is actually holding more of the risk? So we throw this into our comparison list here. And on the cash purchase, you are literally holding 100% of the risk. And you are only holding 20% of it if you finance the properties. Now, another common argument is that, well, if you have a mortgage payment that you have to pay every month on your financed property and something happens, the income goes away or whatever, you're still on the hook for this mortgage payment. So that's risky. Whereas if I own the property for cash, then I don't have to worry about that mortgage payment in a month. Well, technically true, but in theory, if you have $100,000, you should have enough for a nest egg. So in this case, the smart move might be, instead of financing 5 properties, you finance 4 and you keep that extra as a nest egg. Because it's like, if you have the money to pay $100,000 one time, why would you not have the money to cover the mortgages down the line, unless somehow your $100,000 disappeared? But so finance 4 properties and use the extra money to keep in the bank account as a nest egg to cover those mortgage payments. So again, you kind of have to look at this objectively and think, you know, how true are the myths? There are true cases that everyone, you know, there's a basis for all of them, but are they accurate enough to prevent you from getting all of these benefits from financing? So my vote has always been for financing, but I also have a pretty good risk tolerance. And again, like I said, some people just are not comfortable with it. And at that point, I don't care how high the numbers are, you should pay cash for your properties. You should always be happy and comfortable with what you're investing in, because honestly, life's too short to not. Like, we're in it to make money, but it's not worth losing sanity or sleep or whatever else you might lose. So I wanted to share that with you to really kind of break down the numbers and give you a perspective of what proper financing can do for your investing. So I hope that clarifies any numbers. And again, check out those other videos about leveraging and how to run the rental property numbers. The links are below. And I also have articles, you know, if you want to learn more about the 5 profit centers of a rental property, we have those, everything. So I hope that helps, and I hope that answers some of your leveraging questions, and I hope it gives you a good basis to consider what you want to do for your own investing.